we're a bit disappointed we didn't get that firm commitment. We still remain relatively optimistic that something should happen today. If we look at some of that wording, very deliberate wording in the opening address yesterday, we do believe that there is momentum for that to happen. At the moment, if we look at the fact that crude consumption growth is going to soften to 1.4 million barrels a day over the course of next year, that's not going to be enough to absorb the 2 million barrels a day of incremental supply from non-OPEC producers. And we had the general consensus that the market's around 650,000 barrels a day too fat. We think the magic number is about 1.25 million barrels a day.
And you think we get it with Russia's cooperation?
I think we will, but it's not just the size of those cuts. I think what's going to be more important is the timing. I think too much too soon, that could send a real shock to the market. We could see a spike in that price that could further antagonize the relationship between the US and Saudi Arabia. It could be likely that we see an immediate cut of 600,000 barrels a day, maybe a more tapered, gradual approach, 100,000 barrels a day, incremental over 6 to 7 months.
That's very interesting. And do they give a timeline then as to how long they last, how long they stay in effect?
Well, they were a little bit vague last time. We'll see how we go. But I think it's going to be very different to last time around in December 2016. You know, there the overriding issue was the shale oil glut and trying to clean that up. You know, right now it's got a real moving target. In February, we're going to have to reevaluate those trade tariffs standoff between the US and China. That could send a shock to the demand side. In May also was 180-day waivers for Iranian imports. That's also going to have to be reevaluated. So it is going to be a moving target, certainly.
Yes, and it seems as though it has to be, because you talk about the shale oil glut, and so far that continues to kind of surprise analysts and the market. I mean, why is that? Why did the market get it so wrong on the supply side?
It's hard to say. You know, when we look at OPEC, we have national oil companies with long-term planning. The shale industry is extremely fragmented. It's hard to account for what they're doing. It's very short twitch as well. You know, we can mobilize rigs very quickly into that market. What's been interesting is we do have these takeaway constraints, pipeline capacity constraints in the Permian, which is the main growth engine of US shale. We expected production to soften a bit as a function of that, but really we've seen that capital expenditure diverted into other basins such as the Eagle Ford. So we've still seen a massive ramp up in liquids production from the lower 48 in the US. That could even get exacerbated at the back end of 2019 when these new pipelines come on stream.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.